Right. Welcome everyone. Welcome to this episode of Budget Ki Baat. I have with me Mr. Satish Ramanathan and from JM Financial, of course. And this is going to be again a very interesting section where we're going to talk a lot about the budget and its impact. Before I dive into the questions that I have for Satish sir, I'd like to know from you what are your first thoughts on the budget and a brief about what do you think? How happy are you with the budget?
So, I think rather than being very happy or anything of that sort, I would say it's a pragmatic budget in the sense that it has recognized the issues at the ground level and it's tried to rectify some of it. Budgets are also a statement of politics, and in that sense, to keep the middle class happy was one of the agendas which we all know was creating a little bit of angst in the general public. I think the government has tried to address that. But is this job fully done? I don't think so because it has to be followed up with lower taxes so that lower GST rates so that affordability of goods goes up and actual consumption starts. So that's where we are, and I think it's a pragmatic budget.
Absolutely. A lot of the people are talking about the capex versus the consumption story that's going on. Let's pick up the capex part first. 10.18 lakh crores is what has been set as the number. Then there are, of course, some part of it is also interest-free loans to states. How do you see this number? Is it conducive enough for manufacturing in other industries in the country?
So, in terms of manufacturing itself, if we look at it, we have to break it up into two aspects, or rather three aspects. One is capex related to infrastructure. The second is capex related to factories and all of that. The third is exports of cap goods. So, what was happening is that India was actually struggling in exports last year because of Europe, Red Sea problems, and a host of issues. And it was also struggling in terms of the factory expansion because factories were not running at full capacity for them to want to expand. Now, what this new tariff war has actually set in pace, and what we need to understand is that there are several layers as we go down. The first layer is that the population will not be taxed as income tax, they will be taxed as consumption tax. If you import a product and consume it, if you use a domestic product, you will get it cheaper. And that paradigm is something which US has demonstrated and exercised yesterday. And why is US doing this? It's because it has a budget deficit. It needs to bridge the gap. Very simple. So will it reverse it? Unlikely. It may negotiate, it may reduce rates, but we are not walking away from the table of import duties. Now, if India were to start doing the similar thing of reducing income tax, reducing GST, and raising import duties, I think a lot of factories will start humming once again. And imports of goods and a lot of goods that we see coming in from China, Vietnam, etc., will reduce and they may be forced to set up factories in India. So the velocity of money will go up, the amount of money in the hands of the people will go up, and actually the government may start collecting more taxes and rather than because the economy has expanded. So I think the first phase post demon, post COVID was a phase of actually going after people who did not pay taxes and widening the tax base and then telling people that going legit is the way forward. The second phase is to expand the tax base by reducing the low rates and making people more compliant and uh, going growing the pie itself. So you can have the economy growing as well rather than being throttled by having high tax rates.
Absolutely. Absolutely, sir. Sir, what about the fiscal deficit numbers? 4.8% this year and 4.4% is the target for next year. Do you think this is prudent enough?
I think the glide path is prudent enough, and our consolidated fiscal deficit would be about 7%. But you need to understand that the entire world is tethering on high fiscal deficits, whether it be US, which is also close to 7, or India, which is also close to 7. The only good thing about US is that they have the dollar, whereas we have a rupee which is volatile, and we need to link it some way to the dollar, and therefore we get jammed in that. But broadly speaking, fiscal deficits have shot through the roof post COVID, and governments are working around bringing that down. And that is causing pain, and no two ways about it. Whether it be through consumption or capex, it is causing some pain.
Right, right, sir. Coming to the consumption side of the story, 12 lakhs, up to 12 lakhs, there's no tax, and then there are even more tax breaks. Now, the big question becomes where will this extra disposable income, to say, will flow into? Getting a little sector specific, if I may, which sectors do you think will benefit the most out of it?
So I think it works out to almost 8,000 to 9,000 rupees per month, right? And what we fail to understand is that there has been a significant service inflation, whether it be school education, books, all these kind of things. I think it will go there first. It will be to keep the family happy, and also to some extent, the power of leverage will be played out. So if I get 3,000 rupees, I can potentially buy a refrigerator or a television or a washing machine using a credit card or a EMI facility, and growing the the actual impact of 70,000 can potentially become 2 lakhs or 3 lakhs using leverage.
Right. Do you see this also money also flowing into equities and mutual funds per se?
I think not in the first leg, because I think it will be a relief that people say, okay, I've got 7,000 bucks, let me go and spend it and enjoy it. But maybe some prudent people, which will be very few and far between, may start putting SIPs and growing their book. But initially, I think people have been kind of so, impacted by inflation and all these kind of aspects that they will go ahead and spend it in first impulse. And the government actually wants them to invest, spend actually.
Right. Right, sir. Sir, the tax breaks are one part of the story which address kind of the urban class, the middle class of India. Then there are also a lot of agricultural projects and schemes that have been launched. So that kind of cater to the rural economy of India. Which do you think is going to have a big, while right now everybody is talking about the tax breaks and the urban class, there's a significant chunk of it goes to the agricultural, the rural classes as well. Which do you think is actually going to have a bigger impact?
So I think we look at rural as a silo and urban as a silo, but there's actually a lot of interconnect, right? In the sense that if there's urban prosperity created, that money trickles down to rural either through transfers or through purchase of goods or through purchase of land, whatever it is, right? So I think that circularity of the economy will be all through. It may come unevenly. Probably the first leg will be urban India. So far, what we heard from FMCG companies is rural has already recovered and urban is yet to recover. This will give a fillip to urban India.
Right, sir. There were a lot of other schemes as well. We had the Heal in India. We had FDI cap for insurance sector being raised. We had some nuclear projects. We had lithium ion and other scrap metals policies for to boost EV. Which of these other projects do you think are some of the can form some interesting themes to come in the near future?
So these themes will take time to play out. And what happens is that you say nuclear project, it takes 7 years for a nuclear project to come out. So I think the direction has been set by the government. But what happens is that you will see a stock flying saying nuclear, 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 and then it will also fall 2 years later or 1 year later because there's no demand. Because these projects are long cycle projects, and we need to bear that in mind. And that's precisely the reason why the government decided to go towards consumption, because it's short cycle. I give the customer or taxpayer 8,000 bucks every month. He's going to spend it. He'll actually boost the economy in that sense.
Right, right, sir. Sir, talking about taking this conversation a little ahead as well, not per se just this budget, but any interesting themes that you see unfolding in the next 5 years to a decade?
No, I think definitely. I think the shorter term may be volatile, but India's competitive advantage in chemicals, manufacturing, engineering, textiles, all are still there, and nothing has changed. The market fall blinds us to the competitive issues that we enjoy, right? So we think that because the market has fallen 15% or 12%, that everything in India has reversed. It hasn't. It's actually things are getting better for us in many aspects. If you look at the competitive intensity of from our neighbors in textile sector have come down, and similarly in several aspects, chemicals, etc. So India will have to be seen as a reliable trade partner, and we need to attract capital from FDI and get those investments here, which will lead to job creation. But what has happened is, I think the market has extrapolated this a little early and kind of thought that everything will happen tomorrow. Obviously, nothing happens tomorrow, it happens in the due course of time. And therefore, I think that expectation and reality mismatch is being corrected in the market, after which there's nothing wrong with the economy per se. There's been a bit of a slowdown, but nothing to fear that we are going under or anything of that sort. And it's a very rare phenomenon that you have consumer, corporate, and government actually paying down debt and the economy still growing.
Right.
So we have come to such an extent. So we are actually in a good place, and we are going to see manufacturing come to the country. The cost competitiveness of India has only gone up, not come down. And I think the diversification impetus is only increased, not decreased. So people will use the China plus one factor to come to India.
Right, right, sir. The recent past few months have been very volatile for investors. Any advice there?
No, I think there has been a fair bit of panic. So everybody who sold during the panic seemed smarter than the next day, right? If I sold something and the stock is down 5%, I look smart. It was the reverse when it happened in the previous year.
Yeah.
So I think that panic has settled. It will have to play itself out. There's no short-term remedy. But the fact is, there is no increase in capital gains tax. The fundamentals are strong, if not improving. Whatever weakness that we had has been addressed. So all these issues lead me to believe that to panic and sell many of the small cap stocks which had a particular reason for having added to the portfolio is not to be dumped just because the market is down.
Absolutely. Absolutely, sir. Before we conclude, sir, any parting advice for our viewers out there? It may be related to a key takeaway from the budget or otherwise something that they must always remember.
I think the broad-based economy that India offers means that being invested is the best way forward. One, we did see an extreme degree of overvaluation in June, July, some of which has been corrected. Maybe a little more correction may take place in the form of a price correction or time correction. But I would think that after that, we are in for the next leg of returns coming through. So the way I would guide investors is to be near-term cautious, long-term bullish, and near-term cautious because do not expect too much of returns because of the valuation, because of the volatility, and all of that. That's what I would advise investors.
Awesome. Thank you so much for your time, sir, and thank you for your insights. I hope you'll allow us to interview again in future and learn more from you.
Sure, definitely. Pleasure talking to all of you. Thanks, Team ICICI.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.